Well, we are moments away from the Fed's highly anticipated statement. What will the Fed do? Well, let's bring in our panel of Fed experts. Joining me now, Michael Cox, former chief economist and senior vice president of the Federal Reserve Bank of Dallas. David Jones, former Federal Reserve economist, and Keith Springer, president of Springer Financial Advisors. Phil Flynn joins us from the pit at the CME. And still with us, Nicole Petalides is on the floor of the New York Stock Exchange, and we still have Sandra Smith. We've got a full house. Okay. Let me start with you, Michael Cox. Last time you were here, you seemed to hint that you thought the Fed was out of ammunition. Now, you use a lot of weaponry analogies, so I'm going to say, are they at least down to a slingshot right now?
Slingshot, yes. I said BB gun, but you may be more accurate, down to slingshot. The Fed actually tried some of this once before, when they were doing all these other things, QE1, QE2. They sold their Treasury bills. They've already liquidated the shortest end of their portfolio, but they didn't make an announcement about it back then because they know it's not a big deal. This time, with nothing left, they're going to make a big deal about it.
Keith, I want to turn this to you now, ask you the question. I know in your notes you mentioned that there is a possibility of something greater than a twist, that possibly a QE3 could be announced today. Do you still believe that?
I do. I think it's important that we separate the rational and the emotional. The rational market, the economy is one thing, but we've got to consider the emotional aspect of investing. Investors, the public, consumers, they want to see that the Fed is doing something. They want to see that they're being proactive. The Fed isn't the best secret keepers, so I think a twist is certainly a given, and I think some sort of buying program is going to boost stocks. We've got to remember, Bernanke loves the wealth effect, and he likes the idea of stocks raising and rising and giving people that feeling of a wealth effect. So I really think they could do a little bit more than what everybody expects.
Michael, we're just moments away, and while we have that time, I want to ask you, there are a couple of other options that are less dramatic in a sense, maybe not twist-worthy or QE3 dramatic-like, but they include things like giving very direct language, even changing the interest rates on the excess reserves that are kept at the central bank. What do you make of these sort of less impactful, less significant moves that the Fed could come out with in moments?
I think these are all very dangerous, and they're very dangerous in the sense that they keep the people on the edge of their seat waiting for what the Fed is going to do to solve America's problems, creating kind of a dependent relationship between people and government. We have essentially both monetary and fiscal policy now saying we'll solve your problems. So if I'm unemployed, for example, and I'm maybe I need to go get retrained and retool and learn something, but as long as the government's going to tell me it'll be okay, we're going to do the right thing to get the economy going again, I'm not doing what I need to do. So, I mean, I think that this is the Tocqueville kind of thing that's going on where the government's creating a dependent populace, and I just wish they'd say, look, we don't solve your problems, you do. But they won't say that. No. They need to. They need to stop this kind of dependency relationship that they're definitely going down this path over and again.
Well, Keith, everyone's right now in a dependency culture, if you will, especially Wall Street, on pins and needles at this very moment. Ben Bernanke really is a big believer in the wealth effect. What can he do? Because he has sounded extraordinarily frustrated about the fact that this virtuous cycle hasn't begun. What can the Fed do? What must they do to finally get that going so that, maybe the economy does pull itself out of this?
Well, all he hopes to do right now is to get the stock market going. He said that a few months ago, that the people see their 401k statements and they hope that the wealthy, at least, will start and continue purchasing. And we've seen that in many stocks, many high-end stocks like Tiffany's, while the low end has suffered. And I think he's going to try to continue that, and he's basically trying to wait it out. He's trying to give enough people with a lot of money or enough people with money the ability to go out and the belief to go out in there and spend more, which will buoy the economy and at least keep us out of recession. Not a lot of growth, maybe 1%, maybe 2%. The projections of 3 or 4% are a dream. I think we all know that. But at least something to keep us out of a deflationary environment and out of a recession. And that's what they have to do. What's so critical for investors is that they don't buy an all or none investment. They make sure that they're in the sweet spot. For instance, that's what we do, finding the sweet spot, looking for dividends and income, and not taking so much risk that everything is at risk on whatever the Fed decides or what the market does on a daily or weekly basis.
All right. Michael, a minute ago, David mentioned the fact that there's a fiscal side to this equation. As a former Federal Reserve person, do you sense there's a serious amount of frustration on Ben Bernanke's part that Washington just can't get their act together and do their part to spur the economy?
Oh, yes, a tremendous amount. And he must be also fearful of the $14 trillion in government debt looming over the Fed, begging the Fed to monetize it in order to eliminate it. So, I mean, I would not want to be the Fed chairman in this situation with such a loosey-goosey fiscal policy. Let me come back to this interest rate thing. While I agree with some of your previous interviewees that this won't work. The Fed is going to sell from the short end of its portfolio, buy long, and that'll lower the interest rate on long-term securities. But what we see already is that for example, the interest rate on mortgage securities, on mortgage debt is as low as it's been in 60 years. It's lower than it's been in 60 years for the prime rate. Most of your corporate rates are quite low historically, and you can't expect them to get them 0.1% lower. So I think what we're doing here is we're purely operating in the emotional side, not the fundamental side, trying to get people just to believe that the Fed has something left they can do for consumer confidence.
I believe you in that sense, Keith, because, you know, what we continue to see the Fed do is to try and spur and create this incentive to borrow. But we have householders, consumers, businesses that frankly aren't doing it, and moving things down fractions of basis points isn't sparking them either. Keith, what do you think about this? What about the whole...
The Fed approves a twist in its securities holdings towards longer-term asset purchases. It approves Operation Twist, up to $400 billion worth, to help push down longer-term interest rates. Reading now from the statement of the Federal Open Market Committee. To support a stronger economic recovery and to help ensure that inflation over time is at levels consistent with the dual mandate, the committee decided today to extend the average maturity of its holdings of securities. The committee intends to purchase by the end of June 2012 $400 billion of Treasury securities with remaining maturities of 6 to 30 years, and to sell an equal amount of Treasury securities with remaining maturities of 3 years or less. This program should put downward pressure on longer-term interest rates and help make broader financial conditions more accommodative. The committee will regularly review the size and composition of its securities holdings and is prepared to adjust those holdings as appropriate. And there's more here. To help support conditions in mortgage markets, the committee will now reinvest principal payments from its holdings of agency debt and agency mortgage-backed securities in agency mortgage-backed securities, new purchases of mainly Fannie Mae and Freddie Mae debt. In addition, the committee goes on to say it will maintain an existing policy of rolling over maturing Treasury securities at auction. Here's more on the economic outlook. The committee continues to expect some pickup in the pace of recovery over coming quarters, but anticipates that the unemployment rate will decline only gradually toward levels that the committee judges to be consistent with its dual mandate. Moreover, there are significant downside risks to the economic outlook, including strains in the global financial markets. The committee also anticipates that inflation will settle over coming quarters at levels at or below those consistent with the committee's dual mandate as the effects of past energy and other commodity price increases dissipate further. However, the committee will continue to pay close attention to the evolution of inflation and inflation expectations. The vote on this was 7-4. 3 against, dissenting once again, Richard Fisher of the Dallas Federal Reserve, Narayana Kocherlakota of the Minneapolis Federal Reserve, and Charles Plosser of the Philadelphia Federal Reserve, who, the statement says, did not support additional policy accommodation at this time. Back to you.
Thank you very much, Peter. You've heard it. The Operation Twist has been, and the Fed says they approve it. The number of $400 billion, a little bit more than what had been whispered, $300 billion. We saw a slight uptick momentarily, but now the market is beginning to free fall. The Dow off 95 points right now. So I got to go back to you, Keith, because you were the one who suggested that there wasn't more, there wasn't a QE3 in there, that the market would sort of recoil and react this way. What do you think right now?
We got exactly what I expected. We got an additional $400 billion. We got the continuation of what I call QE mini-me, which is the reinvesting of the proceeds, which was about $300 billion in itself. So we have actually more than we had with QE 1 or 2. I think the markets over a period of time are going to like this. I wouldn't be surprised if we turned around. Maybe the sell-off dissipated. It happened last time and turned around and started going up. But we've got to remember, this is the long-term implications are still very serious. This is what I wrote about in Facing Goliath. The headwinds are still very, very serious with less spending, the over-leveraged population. The Fed is going to have to continue to do this until they're no longer allowed to, and the only way they're not going to be allowed to is with rising interest rates or when the bond vigilantes step in and force them to stop. Otherwise, they're going to keep doing this as long as they can, and really, who could blame them? And we're all going to complain about the deficit, but they're going to keep going as fast as they can and as long as they can, borrowing money to try to stimulate the economy. But in the end, it's all going to fail. I think we all agree on the panel, but they're going to keep trying. But I like the fact that it was more than was expected. Not so much for the economy or the long-term debt of the nation, but really for the emotion of the stock market and for investors. That's what people wanted. He gave people a little bit more than what they were hoping for.
This 1 minute, I want to give one question to each of you guys on our panel today. QE3, is it dead or is it still on the table? Keith?
It's absolutely on the table. They're following the Japanese playbook. They're going to keep throwing money as long as they can, as long as money is cheap.
All right.
Bond rates are cheap. They can borrow.
Michael?
I think it's definitely on the table.
It's on the table, and we've had our first lost decade already following Japanese-style policies. They had two. Perhaps if they keep it on the table, we'll have two as well.
All right, David?
It's on the table, but unless we have a recession, and I don't think we will get a double-dip recession, it won't be used.
All right, we're going to have to leave it right there. We've run out of time, guys. Thank you very much for your time and your thoughts on this analysis of what happened with the most recent Fed rate decision and Fed decision, which didn't have anything to do with rates, actually, reinstating Operation Twist.
And we should point out the market is really starting to fall apart right now.